Ladies and gentlemen, a warm welcome also from my side. I'm Thomas Pohl, the Secretary of the Board to the Swiss Finance Council. I would like to quickly introduce you to the discussion paper, which you hopefully have all in front of you. What we kind of aim to achieve is what was already outlined. On the one hand, we want to show what has been achieved in terms of potential measures, in terms of derivatives reform, in terms of governance and reforms to incentives in order to stabilize the financial system and in particular the banking system. We then have 3 case studies where we look at evolving risks, was mentioned them, regulatory complexity, cybersecurity and climate change risk, which from our perspective require a new model of engagement, a closer cooperation between the private and the public sector and also with academia and societal actors. And we, out of this analysis, then develop a few recommendations. Well, on the one hand, we outline what needs to be finalized in order to kind of, achieve completion of the post-crisis financial reforms, and then kind of with a forward-looking view how to tackle these evolving risks. We have kind of on this slide, and the graphs are taken from the discussion paper, a few illustrations of what has been achieved post the financial crisis. You've seen that basic capital requirements, both on a risk-based basis as well as on a leverage ratio basis, have essentially been fully adopted across all major jurisdictions. Also on the liquidity side, we're moving towards full adoption from a liquidity coverage ratio perspective. On the net stable funding ratio, there are some further discussions going on. So there's formal adoption, but there's also a very significant buildup of resources, and that can be seen on the second chart, where we see the gaps that are, coming up if you increase the requirements back in at the beginning of the decade. They have essentially been closed both on the capital as well as on the liquidity side. And banks continue to build up loss-absorbing capacity, which is the key innovation of the total loss-absorbing capacity concept, the TLAC or the MREL concept in the EU speak, where banks are building up this loss-absorbing material in order to be prepared also for a crisis where the going concern capital is no longer sufficient, and these are issued to very high degrees currently. A small aspect that I would like to spend a few minutes on is kind of the actual increase in effective capital requirements, because there have been taken several steps across the last few years which lead to a buildup which is not fully reflected in just higher ratios, and this is not kind of our analysis, but it's the analysis of Mark Carney, BOE governor and former chair of the FSB, that if you start in a case study or kind of with a hypothetical example of 10 units of capital in a Basel I environment, under Basel III rules, you end up with effective capital requirements of almost 90 capital units. And this comes in the following steps, which are outlined just behind me. So in the move from Basel I to Basel III, the eligibility of instruments that can be accounted for as capital has decreased or has been tightened very significantly. So instruments like Tier 2 instruments, which could be accounted for as capital under previous rules, are no longer accountable as capital, which reduces the eligible amount of capital by 40%. So in order to have the same amount of capital, you need to increase your capitalization by some 70%. In addition to that, and that's Basel 2.5 essentially, the RWA calibration has been tightened very significantly. So for any given amount of exposures, you have to hold something like 2 times the amount of RWAs, or calculate the amount of RWAs, which then have to be underpinned with capital. In addition to that, ratios have been increased very significantly, which then takes the total effective capital requirement to something like 85 in our example, which is kind of 8 times and 10 times, up to 10 times an increase in effective capital requirements. On top of that, we'll have the requirements which are labeled as Basel III Final or Basel III Plus, which is kind of the package that has been presented by the Basel Committee at the end of 2017, plus the revised market risk framework. All this, Mark Carney, not the Swiss Finance Council. In addition to this, we have kind of additional requirements in the capital space, like the leverage ratio as a backstop, the Basel III final floor, calculated on a standardized approach as an additional backstop. We have stress testing in the main jurisdictions, and we have the total loss absorption capacity framework, which I mentioned earlier on. So if we look at the broader environment, comparing what we had before the crisis and what we have today, we see the following. So in capital, we have significantly enhanced rules and significantly broadened rules. Before the crisis, we didn't have liquidity requirements. Before the crisis, we didn't have requirements for recovery and resolution planning to address the too big to fail issue. Derivatives were traded over the counter with no transparency, no reporting, nothing, and corporate and risk governance was obviously not up to the standards. If we compare that to today, we can see that all these issues have been addressed. We talked about capital already, we talked about liquidity already. We have recovery and resolution plans for the large financial institutions. We have the TLAC concept. A very significant degree of derivatives are cleared via central counterparties, and you can find some detail in the discussion paper. And you've got much more transparency via centralized reporting, and you've got margining requirements. In addition to that, you have kind of, seen alignments to the incentive framework and to the governance framework. The role of this chief risk officer, for example, in the group executive board or in the most senior decision-making body has been strengthened significantly according to Basel principles, and this is the practice in the financial institutions, at least that I know. The chief risk officer has the final say on any business decision, which obviously, enhances the overall risk governance very significantly. Also on the board level, there have been adjustments to the board structures, strengthening the risk aspect of that. So far, so good. But obviously, there comes some complexity, and this is what we discuss in the first discussion, in the first case study of the discussion paper. So if you look at the capital side, you can see that you have conflicting rules. You've got risk-based capital requirements, you've got the leverage ratio, you've got stress testing, essentially covering the same risks. You need to see, how are they calibrated appropriately in order to avoid the wrong incentives. Another complexity arising from kind of this revised framework are some contradictions between different requirements. So in order to fulfill your liquidity coverage ratio, banks are required to hold high-quality liquid assets, but they drive up your leverage ratio denominator, so you have to underpin them with capital. You hold liquidity because you have to, and you pay for it with higher capital requirements under the same rules. We have liquidity requirements in the going concern, but we're only starting to discuss liquidity needs in resolution. This is one of the key open aspects where we call for good alignment between the two aspects. We have, on the one hand, requirements to centrally clear your OTCs, but then your exposures to the CCPs also add up to your capital requirements, to your leverage ratio denominator. And it's key to avoid kind of an over stretching of the security aspect with excessive capital requirements also for these transactions, because you have higher capital requirements for reduced risk, significantly reduced risk. You know where your exposures are on the derivative side. You have kind of the possibility to streamline them and to net them. This is an important aspect that we ask the authorities to look into. And in addition to that, you have new systemic risks in the central counterparties, which need to be carefully accounted for because they obviously centralize quite a bit of the activities. Summing up, there is quite a bit of regulatory complexity, which requires a new form of dialogue from our perspective, similar to the issues that we discuss in the next two case studies. An additional aspect that will come up in the next panel is the question of fragmentation of resources. So I'll only treat that very, very quickly. Key concern there is that while it might make sense for any given individual regulator to centralize and ring-fence as much resources as possible within any given jurisdiction, this adds instability to the overall system, right? Because these resources then in a crisis, they cannot kind of be moved around quickly and freely in order to address potential needs. And by the very nature of a crisis, it hits us from somewhere where we don't expect it. And therefore, fungibility of resources is very important. If we go further into the second case study, and I'll also only touch on that very quickly because we've got the panel looking at it. Key concern there is that we need this close dialogue between the authorities and between the banks in order to address this rapidly evolving risk. Cybersecurity is a particular issue for banks, according to recent studies, but you can also find referenced in the discussion paper. Banks are twice as likely to be attacked than other sectors, and the value at risk is also about double the amount compared to other sectors. So it's a thing that is very important for the financial institutions, where financial institutions are investing significant resources, significant board attention, and where kind of this close dialogue with the authorities is key. And given that it's not kind of, jurisdictionally confined challenge of cybersecurity, international alignment, international cooperation is key. We have developed some recommendations which you can find in the discussion paper regarding the need for common infrastructure and intelligence sharing, the need for consumer protection. There is a human dimension to cybersecurity via your employees, via your clients, via your third-party contractors as well. So this needs to be kind of carefully considered, corporate governance, and touched upon that the importance of consistent regulatory frameworks and a cross-border applicability. These are key aspects that I trust the panel will also touch upon. The third case study touches on climate change risk, a topic again brought up by Mark Carney already in 2015, and there's a risk perspective to it with physical risks, so your bank could be damaged. There are liability risks. Investors could think that certain players are responsible for climate change risk and hold you accountable to that. And there are transition risks which financial institutions are exposed to. If change goes on very quickly, your investments into some traditional fossil fuel producing enterprises might no longer be worth what you thought if this transition goes more quickly. This is something that the banks have detected early on, and where, according to surveys, banks are well aware of. More needs to be done in order to risk manage these developments. And this is something which also the international authorities, as well as the EU authorities, as well as jurisdictional authorities have taken up, and where more dialogue is needed. The aspect that we want to bring up in the discussion paper and stress a bit further is, in addition to the risk aspect, you have to be prepared for this change, there's an opportunity aspect, in particular in the finance space, where we can say we can use investors' money in order to address climate change risk via the instruments commonly labeled as sustainable finance. So there's a market opportunity in mobilizing financial resources in order to contravene these trends which are exposing not only banks but essentially the whole economy, all households, to climate change risk. And in order to kind of use this opportunity of private investors' money, we are developing a few recommendations which you can also find in the discussion paper. And essentially they can be grouped into three buckets. Removing regulatory hurdles, make sure that the regulatory framework is established in a way that it facilitates sustainable finance solutions, that investors can invest into them also early on. It's obviously good to invest into an equity fund where stocks are picked according to the corporation's exposures to fossil fuels or other environmental or sustainable aspects, but it's much more impactful if you can early on provide equity to young startups trying to tackle climate change risks. And there are some kind of limitations from an investor perspective, investor protection perspective, but they need to be carefully calibrated with this overall goal of strengthening sustainable finance. Consistent implementation is something that is also very important. Again, similar to cybersecurity, similar to regulatory complexity. It's not kind of, something which is jurisdictionally confined and which can be addressed only kind of within any given country, but it's a global challenge and therefore needs to be addressed in a globally consistent way. As a first step, establishing a common ground on what we talk about and what kind of taxonomy, what the issues are and how we define an issue would be an important first step. And then, in particular, in the area of climate change risk, but also for cybersecurity, it's key that we have good data in order to model these risks, in order to understand the implications, and then kind of act accordingly. I think on kind of the narrowly defined area of weather hazards, there is good availability of data, in particular in the insurance space, but on the broader implication of a transition to a low-carbon economy, there is much more work that needs to be done, again in collaboration between banks, authorities, and the academia. You can find at the end of the discussion paper then a set of 3 recommendations along the lines which I explained. We need to make sure that we conclude the post-crisis reforms and that we understand the implications. Urs mentioned it, regulatory efficiency. The need for impact assessment is also that is very high on the agenda of the FSB and the G20. And one aspect that is particularly important to us is that you assess the cumulative effect. So I think the authorities are very diligent in understanding for any given measure the impact, so for capital and liquidity. Also, there was an important initiative to understand the interactions between clearing requirements and capital requirements, but there is a need for a holistic assessment of how much stability is needed. And there is a need for kind of a review of what can be achieved in terms of kind of the targeted amount of financial stability with potentially reduced set of regulatory requirements. This is also something that the FSB has prioritized for its work program. This year, again, what we are calling for is that there is kind of a joint interest in achieving financial stability, maintaining financial stability in an efficient way. Which is kind of the second set of recommendations, which you can find in the discussion paper. And the third set of recommendations focuses on these evolving risks, which require a new dialogue from our perspective, given the global and very comprehensive nature of the risks. So I hope that you got a discussion paper when you came in. If not, we've got further copies. It's also put on the website. We'll also put the slides on the website in case they're of interest, and I look forward to the discussions and would call on Robert Priester to introduce the first panel. Thank you.